Another important player, particularly in the innovation space, are the corporate innovation groups and the corporate VC funds. And those are two different beasts. These corporations understand that technology is potentially going to disrupt their existing business models, and so rather than just wait to be disrupted, they want to engage. They want to learn, and they can do that in a few different ways. Maybe they're going to have a corporate accelerator who's going to work with startups and kind of try to co-create. Maybe they've got a corporate VC, $50, $100 million, where they have an ability to make investments. It's important to think, why do they do it? Well, it's not so much because they think they're going to be really successful as a VC, although it doesn't hurt if they are. It's more that they want to have a seat at the table and see what technologies and ideas and emergent business models might be relevant to help them grow their core business. So those players, they might be willing to do a one-off innovation challenge. It's a great opportunity for early stage companies to get access to the expertise and to the distribution capabilities of a bigger company. And that's another source of funding. It might not be equity funding, but it's an important source of resource, shall we say. So I've been asked the question, in terms of the differences of what the three different kinds of VC firms I just talked about. You got the micro VC, basically small venture firms who are focused on financial return. Traditional VC firms, which are the bigger venture capital firms focused on financial returns. And then the corporate VC, which are focused really more on strategic. Obviously, if they make money too, they're happy, but it's really more about strategy, I think. The difference with the micro VCs and the traditional VCs is the micro VCs are probably co-investing with the angels and the super angels in a local market, and they're looking to assume maybe a bit more risk. The traditional VCs, they would prefer a little less risk in the portfolio, and they want more growth. So I guess if you're somebody, the venture capital model is really in the jet fuel business, and they want to provide jet fuel for people that want to build jets, okay? That's the model. The corporate VC model is different. They're looking to figure out how to make sure they don't get disrupted. They want fresh ideas, co-creation, collaboration. They want to stay relevant. So it's a completely different beast.